Ahoy there, trader, and welcome back. Welcome to this week's workshop. Thank you once again for your time, for your attention, and for turning up on a Friday morning. This week, we've got a really cool way to use Delta, and it's one of the Greeks. We tend to trade, when I say we, it's me, it's the royal we. We is me. We like to use, and certainly all our traders and the people who follow this particular logic, we like to trade with stock options. And one of the questions that I was asked, which is something that I talk about in the training, is a probability cone. And I generally use probability to basically describe some of the advantages of options. And the way that I teach the strategies that we use, we've got several option strategies, which are my go-to and preferred way of doing things. The way that we use the option strategy and the way that I teach to set them up, we're doing all the probability stuff in the background. I've done all the work for you so that you don't have to work it out every time. So occasionally questions come up, like, because not every platform has this probability cone. So one of the things that comes along with stock options, or allows us to do, or one of the things that it's based on, a part of the way that the influence of an option price is calculated, it's highly related to a standard deviation. So when we're talking about standard deviation and probability, and it's all in terms of theoretical probability. And the idea is to help us figure out what makes sense if we're buying or selling options. So one of the things that I describe in the option training program is to think about this cone. So if you put your head on one side, you'll see that this is a pretty standard probability distribution cone, but it's overlaid onto a chart so that it's not just that. Again, if we think about the probability distribution, you probably recognize the bell curve. If I can draw properly, it's a little bit shallower. So the probability distribution says that 50% is in the middle, and over on the left, you've got the outliers over on the right, and then you've got the 68%. I mean, some of you might remember it from your school days, or you might be more familiar with it right now. Purpose of this is not to teach you about probability distribution. It's just to show you that it's used in the calculations, and what sometimes some of the chart platform, this is Think or Swim platform. And one of the platforms that I use in the option trading program that we have talks about how to do this. And I only really go through this on the training so that you can have a visual comparison, because for a lot of people, option trading is brand new. There's a lot of information, but it's not complex. And that's what I'm hopefully going to demystify some of the elements of that complexity today. So option trading is, again, it's about probability. And one of the things that I like to talk about is what if we were bullish on, again, this is Microsoft. If we were bullish on Microsoft, what would be a normal movement? At the moment, you could probably say $100 move on Microsoft would be quite normal. But under normal circumstances, and that's the key element here, under normal circumstances, would it be reasonable to expect a $100 move up? Now, what we need to do is to add in the next 30 days. Under normal circumstances, would you expect price to go from, well, we're around about $200. Would it be reasonable to expect a 50% increase in the stock price? And I've got to add under normal circumstances. Just give me a little yes or a no. Is that a reasonable expectation? And again, I appreciate right now with all the weird stuff going on at the moment, you could probably answer yes to a ridiculous number. But the key point here is under normal circumstances. I think it's fair. Yes, everyone's in agreement. It's not a normal expectation, and that's the key point here. And that's what this probability cone helps us to figure out. So one of the things that this does, it's a visual reference to several things, but it's that kind of combination of implied volatility. So implied volatility helps us to figure out, well, what potentially is the volatility of price? is that $100 move, is that a realistic expectation? Now, on face value, that $100 move, everyone's in agreement. You know what? It's probably not a normal or realistic expectation in the next 30 days. So then that leads to the question, well, what would be a normal, realistic expectation? And that's where that probability cone, that standard deviation cone comes in, because that's all this is on its edge. It's that normal distribution. What would be a normal range of expected movements? So relative to time, and these dotted lines, these are the expirations. So you've got September down here, you've got October expiration there. That's what these lines are. So up to the September expiration, which is here, a normal expected range of movement is going to be about $240. So from where it is right now, and based on time and a normal expected movement, 68% of the time, price is going to be between this upper boundary and the lower boundary at the point of expiration. So if we were to buy a September option, this cone, let me just tidy up. This cone is saying on the September expiration, 68% of the time, price is going to be inside of that probability cone. That's a normal expectation to expect. I'm just going to pause there. Does that make sense? The probability cone is telling us, and it's worked out for us. We don't need to know the maths. It's done for us. Under normal circumstances, price is going to be inside that cone. So relative to time, so the further we go out in time, then the wider or the fatter that cone gets. And that helps us to figure out, so we can work out that relative to time, and we're just using the expirations for the options that we would typically be looking at. So we've got 2 time points marked off here. Relative to time and normal expectation, price is going to be at the outer edges of that certain percentage of time. We know that it's going to be inside the cone 68% of the time. So if we're at the edge of the cone, it's going to be, well, the upper and lower boundaries. Let's split this in two. 34% of the time, price is going to be at 34% of the time, price is going to be at the edge of the cone on the day of expiration. At the edge of the cone, 34% of the time. And this is the argument for selling options. And I want to emphasize some points here. What we're saying here is that cone represents on the day of expiration for the option at that the edge of the cone, or the nearest strike to the cone, to be 1 penny in profit, or in the money more specifically. For that to happen on the day of expiration, the probability theoretically is 34%. Now, it's a bit of a mouthful, I'm sure you can appreciate, but I'm trying to be as accurate and specific as possible. On the day of expiration, to be 1 penny in profit on the strike at the edge of the bell curve or the probability cone, for that to happen, theoretically, because it's not a reality, it's a theory, 34% of the time that will happen. We know it's going to be inside the cone 68% of the time, and at the edge of the cone 34% of the time. Either the upper cone or the lower cone, edge of the cone. And that's a moving cone. Every time price moves, that cone is recalculated. So let me just pause there. Does that make sense? On the day of expiration, the probability that price, or the strike price, will be 1 penny above the edge of the cone is 34%. Cool. I think everyone gets it. Yeah, lots of yeses. Perfect. Again, it's a bit of a mouthful. It sounds like a tongue twister. But I think if you can get this logic, a lot of the option theory, and again, I'm emphasizing that word again, it's theory. It's not always a reality, but it's theoretical. And I think this is where people get hung up. Now, if we were to buy an option at the money, my default option is to buy an at the money option for 50 delta That's what at the money means, about 50 delta. And that means that the probability is going to potentially increase or decrease. The fact that I could make or lose money is 50-50. It's either going to go up or down from this point. So that means that the probability is 50%. And also the delta is going to be 50 delta or 50%. So what we're going to start looking at is a lot of these things that we can look at, that the option chain, all of these numbers that I'm mentioning can be added as an extra column on the option chain. And what I'm going to do is I'm going to point out that, hold on, delta, a common number that some people look at, is a number or a reference that we can use as a back of the envelope proxy for lots of other things. So the first question that I was asked this week was, okay, Phil, I like what you've done in the training. I love the explanation. I'm trying to give you the really quick version. I spend an hour or two talking about this in the training, but I like what you explained. I like that, but how do I get this cone on my charts? Because I like the visualization of where the probability curve is. Because if I'm going to be buying options or selling options or doing a combination, and I'm looking at some of the strategies that you talk about, then this probability cone is important. I want to know where this is so that I can set up my strategy as I've explained. But not every platform has this probability cone. So to answer that, everyone has access to this, but not everyone has the ability to put it on their chart. So that's what I'm going to point out right now, and then we'll look at some cool things that we can do with delta. So the first thing that we're going to look at is I'm going to look at the September expiration, which is this line here. And I'm looking at the calls, first of all. So I'm looking at the calls. So what I've done is I've highlighted the stock price on the chart, and I've looked at the 30 delta strike right there. So the nearest strike, so this is delta. You can add this as a column on your option chain. Now, what I'm showing is this is the edge of the bell curve. So it's not exactly 30 delta, as you can see there. It's 32. And if I continue to go along, I can see that the strike price right next to that 30 delta is $240. And if we go back to the chart, we can see that the edge of the bell curve, the exact number as the mathematics works out for us, is 237, but the 240 strike is just a little bit above it. So it's not exactly on, but then we're not looking at exactly 30 or 34 delta. We're looking at an approximation, and that's all I want to do. I just want an approximation. I don't need the exact number. And it means that I don't have to have 50 columns. I don't have to have this giant spreadsheet on the option chain. I can just look at one thing and work it out. I can start to say, where's normal and not normal? Where's the edge of the bell curve? If I was to buy options that are out the money outside of that bell curve, then the chance of them making money is diminishing, from 34% down the edge of the bell curve. If I'm buying options that are inside the bell curve, my probability starts to increase that I'll make money. That's what I'm trying to figure out. I'm using the bell curve. I'm using probability theory to work out, well, what's a normal expected movement and what is an abnormal expected movement, so that when I combine my charting analysis to say, I think there's going to be a $15 move. What does the option theory say? Oh, the option theory also agrees that there's going to be a reasonable expected movement. Great. When those two things marry up, we've got a great trade. So we don't need the visualization. What we can do is we can use delta as a proxy. Where's the edge of the bell curve? So I can buy any of the options up to that point, because that is, under normal circumstances, I've got a reasonable expectation that, this is a good option to buy. And this is the last good option to buy. Let me say that again. I can buy any of the options up to this point, and this is the last good option I'm going to buy, because after that, it makes more sense to be a seller of options. It makes more sense to be a seller of options. And we've spoken about this in the past on a previous workshop. We've gone into more detail of strike selection on a previous workshop, so I'll forego the reasoning behind 30 delta. But this is why I'm liking it. It's all to do with this probability. What's a reasonable expectation? So let me look at the next slide. I've prepared a few, and then we should be done quite quickly. So we've got this, the next expiration. So I've looked at the next expiration. We've got 30 delta. So we've got longer time. And now I'm looking at this expiration here relative to the charts. I've gone to the 30 delta, and I found that the $250 strike is the nearest to about 30 delta. So it's just the other side of it. It's not exactly, again, it's not an exact science. It's the nearest to. So we've got close enough. So I know that anything underneath 30 delta, as we go to the at the money, I can buy any of the options up to 30 delta. And this is the last one that I could potentially buy. Everything else would make more sense to be a seller of those options, because the probability of it not expiring in the money makes more sense. And I want to know which option can I buy, because I'm a directional trader. I want to know which is favorably priced, and that's what this is helping me figure out. Now we have the same thing on the other side. I'm going to skip through this quite quickly, but we've got 30 delta on the put side, and with a different time expiration, we've got 30 delta on the October expiration. So what I'm highlighting more than anything is that you've got access to this visualization, this probability cone. So if you don't have think or swim, you can work out where the edge of reality is, the edge of the probability cone, and we can use delta as a proxy for that that edge of the bell curve. And this for me is where it's important. The way that I kind of default to describing this, the probability cone for me, it's the point at which options are priced favorably or not favorably. Because up to, let me just draw the center, I can be a buyer of options all the way up to or all the way down to the edge of the bell curve. But then after that, it makes more sense to be a seller of options after the edge of the bell curve. And so that's really why it's important, because this is where a reasonable range of movement becomes normal to not normal. Because I know from the way that options are priced, that 68% of the time, price is going to be inside that bell curve. So from a theoretical, I'm emphasizing that word again, from a theoretical viewpoint, this is how options, or this is a part of how options are priced. So I want to buy and sell the most favorable options at the right points. And we've looked at the three strikes that I like to buy. I like to buy 70 delta, 50 delta, and 30 delta options, not all at the same time. There's different reasons that I do this. If you want to have a look at the reasoning behind why these strikes, we've done a different workshop, and I rather cleverly called it the Empire Strikes Back. But nevertheless, we've got three strike selections. So relative to the bell curve, if I'm a buyer of options, let's just say that I'm bullish, I've got 70 delta, 50 delta is at the money, and at the edge of the bell curve, out the money is 30 delta. Does that make sense? 70, 50, 30. So in the money, at the money, out the money. And they're all priced differently. In the money has got more value. At the money is typically just time value, and out the money is, again, a lower value, but it's just time value. But you've got to see price move before you see this option accelerate. And I'm going to throw an out there, or do you type of question. Just because you're buying an out the money option, this 30 delta, it doesn't mean that you won't make money. Let me just pause there. Are we all still on the same page? I know I'm going through this quite fast. It is being recorded, and you can watch this back at your own leisure. I go into all of this in a lot more detail inside the profits training in the option trading sections. Quick drink. So the question we left off before I took my little slurp of water was, just because we're buying an out the money option, let's say this one, and we're buying a call and we think the stock's going to go higher, at the money there is 50 delta. Just because we're bullish and we're buying this out the money 30 delta option, it doesn't mean that I won't make money if the stock price doesn't go past the strike price. And I'm going to prove it to you right now, because I regularly buy 30 delta options that never go in the money and make me loads of cash. And here's the trades. Apple, I purchased, let me prove it to you first, and then we'll look at the numbers. I purchased a 475 call here. So the current price is 460. I don't know if you're going to see that on my slide. So 465. Again, this was a 5-day expiration. So it expired on this day. So it had 5 days of life. I purchased it there. The 30 delta option was at 465. So my apologies, 475. So I purchased that option there. So just about there. So that's what I purchased. So I bought an out the money option at 30 delta, and all I need to do is to see price move favorably. Now, in this case, it did go in the money, but you don't need to see price go in the money to make money with options. Facebook was similar. We've had, where are we? Isn't it? Going the wrong way. QQQ was similar. Workday was similar. Abbott was also similar. They were all slightly out the money to be able to make money. So let's go and see this principle on the option chain. So we're on the option chain. We're going to look at Microsoft if you want to have a look at this. It doesn't matter which expiration. I'm just for continuity, because we were looking at it on the slide. I'm going to look at the 18th of September with 21 days to expiration. You can just see it right there. So if you want to follow along at home, you can do. So what we've got here, I'm going to focus on calls. We're bullish. Is the example that we were just going through. So I'm going to look down the delta column, and I'm going to look for the nearest expiration to 30 delta. And we can see that this is the 30 delta, it's between two strikes. So we're never going to get exactly the right strike selection. So I'm going to go for the one that's a little bit further away. I'm going to go for the 28 delta. Personal preference, there's no right or wrong here. So my idea here is it's just the other side of the bell curve, the edge of that probability cone. And if I go all the way along, I can see that we've got the $245 strike. Let me tidy this up a little bit. So we've got the $245 strike. So that's what we're looking at, that strike. I'm just trying to emphasize that's the only one I'm looking at. It's the 30 delta. So we can see that the stock price is 230. So that the current stock price relative to the option chain is there. So if I was to buy this option, price has to go from this point upwards. I know I'm drawing down. It's just the way that the option chain is inverted. But price has to move favorably. It has to go higher. It has to go upwards on the chart to get to from where it is now, $230, all the way up to 245. So it's got to move upwards for that to happen. Now, just because I'm buying this out the money option, and let's just say, again, just to keep it nice and simple, let's just say that it's $380. So if I was to buy an option for it's just dropped in price, but let's just call it 380. So I buy an option for 380. And it's 245 right there. So if I buy that option, it's going to cost me, what's changed a little bit, 375. For that option to make me money, I don't need the stock price to move much. And you can see it if you stair step it. You don't need to go to the Analyze tab. You don't need to do anything weird. We're talking about this. So if I see the stock move one option strike up, that let me restate. If I was to buy this one, if it goes one strike further in the money, it will increase from 845 to 975. So price has to move favorably, and I can work out how much favorably by looking backwards, by saying, oh, if it goes from at the money to in the money, then it's going to be worth more. So 245, if I was to buy that strike right now and it moves $5, then my option is going to be worth the amount of the previous option. So I'll make $1.20. So it's going to be worth 380 to 5. Now it's not in the money. All it's done, if the stock moves $5 up, then my option will increase by $1.80, $180 per option. Can everyone see that it's not an in the money option, but yet I'm making money? Can everyone see that? That's what I want to point out. And this is why I like 30 delta. It's in the realms of possibility, and all I need is a small movement. So one of the things that I like to do is to look at this 30 delta option and say, okay, if I buy the 245 option, and I buy that for 380, which is the number that we used, I know it's changing. If I buy that, can I double my money in a short space of time? Can I double my money in a short space of time? So if the option price goes from where it is now, if this goes to an at the money pricing, so that means that the stock price has moved from 230 to 245, it's going to go from being worth 380 to around about $8. There's obviously a little bit of a time decay. I'm just doing the back of the envelope here. But if the stock price goes from 230 to 245, which is a $15 move, $15 move on a $230 stock. Let me throw the question out. Do you think that Microsoft could move $15 in the next 20 days? Do you think that Microsoft, without looking at the charts, do you think that Microsoft could move $15 in the next 20 days? Up or down? Let's just say that it's up. Do you think, give me a little yes or a no in the chat box. At the moment, yeah. Do you think that Microsoft could move up $15? Yeah, it's not an unreasonable expectation. There's lots of yeses in the chat box. Thanks for your involvement, everyone. But because you're buying an option that's at the edge of the bell curve, that's that $245 strike, and I'm buying it for 380 in this hypothetical example, that's 30 delta. If it moves $15, then that $245 strike will go from out the money at 30 delta to at the money at 50 delta. That will be the new at the money option. So I can quickly look back and say, well, what's the at the money option worth? Well, it's going up already. It's worth about $8. Approximately, it's worth about $8. So if my $15 move happens on Microsoft, I can buy an out the money option for 380 and have 100% return on capital if my expectation happens. Now, we do a little bit more than that. We are obviously layer on the charting, the technical analysis, and all the other good stuff that we like to do to make sure that we're timing our trade to perfection. But on the back of the envelope, we can see that at no point has the option gone in the money. At no point has the option gone in the money or past the strike price. And yet, in this illustration, you can see that you will have doubled your money. So I want to leave you with this thought. You don't need to buy in the money or at the money options to make money. You don't even need to buy an out the money option that then goes in the money to make money. In fact, in this example, you'd probably make more return on the capital, because we've just illustrated that you can double your money by buying, when you do it a smart way. Again, I know there's a little bit more to it than this, but just to illustrate how the numbers work, that's what this purpose of today's session was. When you choose the right stock at the right time and you've got the right expiration, which we teach in our training program, then you don't need the stock price to go in the money from the option strike that we buy, and you can still double your money. If you were to buy the at the money option, you're buying it for $8. So firstly, you're getting a 50% discount on the at the money option compared to 30 delta, a 50% discount. So to double your money, go for 8 to 16, it's got to go from 230 to 250. So you've got to see a little bit of extra movements in actual fact. And if you work the numbers out, it's actually got further to travel to see that same 100% return on capital than it has if you buy an out the money option to see exactly the same 100%. But it's going to cost you more money to buy at the money than out the money for the same 100% return on capital. So you could quite likely buy more contracts for the same dollar risk. So with our same $800, I can buy one option at the money, or I can buy two options out the money at 30 delta. And I can make more money. So the same dollar risk is one of the reasons why I like these 30 delta out the money options. Again, I don't do them on every trade, although when it justifies it, I will buy out the money options. On something like Microsoft, it makes sense because a $15 move, they happen on a reasonable and regular occurrence, especially at the moment. It'd just be rude not to. But ultimately, that's my argument for Delta. It's how we can work out probabilities. It's how we can work out what the edge of the bell curve is. It's how we can choose an option strike that makes sense, that is potentially out the money, and it's still in the realms of reality. And one final thing that I'd like to leave you with. What we've just illustrated when I said that price only has to move $15 higher on again, this is Microsoft charts. Price only has to move $15 higher in the next 20 days for you to double your money, 100% return on capital. You only have to see that move. And what we've worked out as is that these numbers are worked out on the day of expiration, on the day of expiration. And what we've just illustrated on the live option chain is the probability of it touching. So we don't need to hold any of the options that we purchase at any point. We don't need to hold them to expiration. Let me say that again. I don't need to hold them to expiration. So I don't necessarily need to know what the option will be worth at expiration. All I'm interested in is a probability of touch. Probability of touch. I've got it down here. Clues on the charts. So the last thing, just to wrap this all in a bow, is if I'm buying this 30 delta option, 30 delta is approximately saying that on the day of expiration, I've got a 30% probability that price will be 1 penny or 1 cent in the money. That's what that says. But I don't want to hold it to expiration. So what I can do is I can use delta as a proxy for this probability of touch. And probability of touch is 2 times delta. So theoretically, there is a 60% probability that price will touch at $15 profit or the $240 strike. There's a a 60% probability that price will move $15 in the next 20 days. That's why I like 30 delta. And this is the theoretical stuff that goes on in the background. When I'm saying in my daily alerts and in the training that I'm buying a 30 delta, I've done all this for you. But at least now you know why I like 30 delta. It's a realistic expectation that it has the ability to move. I'm not holding it to expiration. I'm only looking for it to touch, a probability of touch. So now it's a 60% probability that price will touch the strike that I've purchased. And as long as it does it reasonably fast prior to expiration, I can probably double my money. I can't say for certain, as we illustrated earlier. No one can say for certain ever about anything, but the numbers are on my side. In fact, over the last 1,500 trades, over the last several years, the reality is combining all of my trades together, it's a 63% success rate. So I'm actually, when you layer on the timing, the charting, the setups, the other things that go into the strategy, the reality is that we're outperforming the theoreticals. And that's the important thing here. We've got a theoretically and realistically favorable strategy that is offering you regular, consistent profits on a daily, consistent basis. And just like any business, there's good patches, there's bad patches, but this is a long-term average over 1,500 trades, and this is how the numbers stack up. Theoretically, we're expecting 60%. The reality is 63% of the time we're making money, and that is fact. Those are facts. Those are facts. And then just to come back and finish on the trade illustration, that was the motivation. That was the driving force behind this trade on Apple. So you've got trend is up. You've got your classic chart patterns, retracements, entry on a pullback, entry at 30 delta, which is over here. And then we've got the chance to double our money. And that's exactly what we did. 103% return on capital, 4 days, 60-minute chart on Apple. And that was the whole reason why we chose the 30 delta option with the expiration that we did, because our average time in trade on a 60-minute chart is 3 days. It took a little bit longer on this occasion. Took me right up to the final bell, and that was the trade that that closed on last week's workshop. And again, that's the reason why we purchased the 30 delta option on this week's workshop. So that's it. We're a little bit over on today's session. Thank you very much for your time. Thank you very much for your attention. If you have any questions, comments, or observations, by all means, feel free to send me a question. But this was cool ways to use Delta. And that was my objective. Just talking about Delta, all the ways that we can use it. We don't need all the other stuff on the option chain. It's essentially just using Delta as a proxy. There's lots of cool ways of using it, and they're some of my favorites and why I like specifically the 30 delta strike, or 70, 50, and 30 delta options are usually the ones that I buy. We focused a little bit more on the 30 delta option, the edge of the bell curve or the probability cone today, and that's where we're at. Thank you once again for your time and attention, and I'll see you all next week.